Hello everyone, welcome back to Financial News at Channel 4, and I'm Ron Jankowski, and my co-host is Paul Munichel with the Ameriprise, and Paul is going to give us an update as to what took place in the marketplace for last week, and I'm going to give you the latest information that took place as of this morning from Ameriprise. They gave us a note, and I'm going to read that to the viewers. Paul, take it away.
Thanks, Ron. I'm going to talk about something that's been affecting all of us, which is product shortages. It's not just a production problem. The lists of goods in short supply, it seems to cover more things than it doesn't right now. We know the virus has triggered economic production and shutdowns around the world and has been a key reason for such shortages. But there have also been two factors on the demand side of the equation impacting availability. First, demand usually ramps up slowly as an economy emerges from a downturn. But not this time. Consumers' solid financial standing has enabled a much stronger rebound in the demand for goods than the historical norm. Now, second, demand for goods has been further amplified by a shift in how consumers are seeking to allocate their spending from services to goods. Now, prior to the pandemic, consumers allocated a fairly steady, maybe 32 to 36% of their total spending outlays on goods. Now, that data is from the Commerce Department's personal spending report from years 2004 through 2019. Now, over the first year of the pandemic, March of 2020 to March of 2021, total consumer spending dropped just by 2.2%. So that relatively modest decline in total spending, however, masked what was disruptive adjustments underneath. Consumers spent 6% less on services, but increased their spending by goods by 7%, boosting goods capture of consumer spending dollars, making it up to 40 to 41%. Now, of course, this pattern has also been a key factor in the inflation picture. It will take some time for consumers' spending allocations to return closer to a normal, a period that should also provide time for production to catch up, thus potentially easing inflation from both sides of the equation. We'll just have to wait and see, and time will play this out, and we'll see how it winds up.
Yes, Paul, I understand all that. And this morning's information that we have from Ameriprise is the U.S. stock index futures are weaker this morning with weaknesses in tech, which I'm surprised offsetting the gains among the financials.
Yeah, we've been seeing this, whatever you want to call it, a little bit of a sell-off the last couple of weeks in the market. And the big tech companies that kind of brought us to these highs have been bringing us down a little bit the last couple of weeks. So that's not anything new from what's been going on.
And the yield on the 10-year Treasury is modestly higher this morning to a near 1.5%.
Yep, remember, if yields are up, the price of the bond is down.
Yep.
So in reaction to changes in the stock market.
And stocks in Asia closed mixed overnight as Hong Kong Hang Seng Index fell more than 2%, and oil prices are a little changed ahead of the OPEC meeting, where members are expected to confirm a production increase. And if that, in fact, does happen, well, maybe the price of oil will reduce and gasoline will come down with it, if all that mix happens in our favor.
Right. If they increase production, theoretically, it should get cheaper.
The supply is greater than the demand.
Yeah. Exactly. And it's just if we can get that delivery chain is also a big key in the price we see at the pump. So hopefully we can
there's
control
a
that.
big risk on transportation now.
Yep, exactly.
Okay, well, stay with us. We'll be right back. Paul has an excellent topic to bring to us on our show called Your Money. We'll see you in a little bit. And we're back with Your Money, and as I had mentioned, Paul was going to be talking about battling inflation threats in retirement And Paul, I'm going to let you take it away. It's going to be an interesting topic.
Thanks, Ron. You know, those of us, when we get in retirement, inflation does pose a bigger threat to them than it would pose someone who's potentially still working. So let's dive into how you can potentially combat against that inflation threat. You know, retirement today, it's common for Americans to spend 2, 3, or even 4 decades in retirement. Now, this means people have ample time to relax and achieve a bucket list of dreams. However, the flip side is that retirees need to ensure they have enough savings to last through their lifetime. One complicating factor is that inflation, it's a fact of life, and it can result in meaningful, higher expenses over time. So as you've likely seen in retirement headlines, inflation rates are the highest they've been in many years. Living costs have risen 5% over the past 12 months ending in June, and that's based on the Consumer Price Index. It's significantly higher than the 1 to 2% annual increases we've gotten used to seeing over the past decade. Now, inflation creates challenges for all consumers, but as I said, it can be particularly difficult for those who are retired and living on a limited income. Higher inflation can throw off the assumptions for regular expenses reflected in your retirement plan. It's unknown whether the uptick in living costs will persist, but you should prepare for the impacts of inflation regardless. So here are a few things to know and do to help you. 1, keep it in perspective. Today's inflation rate of 5% is high by percent standards, but nowhere near a record. We may be a long way from seeing an extended period of high inflation like we had in the 1970s and the 1980s, where inflation in the United States peaked at 13.5%. Now, since 1982, inflation has only been higher than 5% one calendar year, that being 1991, until now. Now, while another decade-long inflation threat is unlikely, living costs in the near term may continue to rise at a fast pace. So we recommend revisiting your expenses if the cost of essential items such as food, gas, plus the cost of discretionary expenses such as travel are busting your budget. You may need to explore ways to cut back. So for example, can you buy food in bulk to maybe save money? Or should you reduce your casual driving to cut down on gas? Or maybe are there other discretionary expenses you can forego, at least for now? Addressing questions like these today could prevent you from spending down your assets too quickly. Potentially adjust your investments to combat this. So is your portfolio properly positioned to keep pace with inflation? It may make sense to keep a portion of your assets invested in stocks. Keep in mind, over the past 30 years, the S&P 500, a benchmark of the U.S. large cap stock market performance, gained on average more than 10% annually. Now, that's well above the 2.3% average annual inflation rate over that same period. Earning higher returns on money you may need 10 to 20 years in the future should help it grow sufficiently to meet inflated income needs at that time. But a large portion of your portfolio should still be invested more conservatively to protect it from market volatility. Also, look at other options to improve your position if you are experiencing financial strains as living costs rise. You may want to consider other options, such as maybe a part-time job or consulting. Even in retirement, it's important to be flexible to react to changing circumstances that may affect even your best-laid retirement plans. Be sure, as always, to check with your financial advisor to discuss your most attractive option to manage today's inflation risks And never take action before you talk to your financial advisor, or even your tax advisor, before you should make any changes. It's always a good idea, because the things we talked about today about stocks and bonds, we don't know what mix is right for the viewer at home, but your advisor should. So you need to speak with your advisor to get the right allocation mix for your needs.
With cost increases and living costs increasing, whatever else, your expenses increasing because of that, you really could blow all your retirement money right out the window
That's the thing.
in short time.
I mean, I've only read about the inflation rises in the 70s. I did live in the 80s, but I was a kid and I don't remember it. But of course, I've studied it. And the inflation we're going through now is already painful, but heaven forbid we get to those levels. You need to start taking action now, just like you said, to prepare for what could come. We don't know what the future holds.
Yeah.
So preparation is always the key.
And, preparation, you probably are very limited as to what your options are. And that's why you should be talking to both your tax advisor as well as a financial advisor.
Right, because you might need to tweak your allocation. Retirees automatically assume they should be in CDs and bonds, and that's great, but maybe you need some growth that stock provides. And that's something we can't talk about in general. You need to sit down and talk to someone one-on-one to figure out what's right for you.
Yeah, and do some projection based on the knowledge that they have.
And that's the thing. And if you're already working with an advisor, that's great.
Yeah.
But if you don't have one or you want a second opinion, you could always call me directly and I'll do my best to help you. You can call me at 708-226-3412.
Okay, Paul, thank you for that. And hopefully the viewers are going to pay attention, as this is really so important right now, what we're experiencing. So for Paul Munical with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you good investment day.